everyone. Welcome to our Magic of Chart Patterns Pro Training course. Glad to have you on board. Thanks so much for joining us this morning. It is Tuesday the 21st of March, 2017. I heard somebody saying the other day, hard to believe we're 17 years into the new millennium. Seems like it was almost, or just yesterday that we're talking about Y2K issues and airplanes falling out of the sky and stuff. Thankfully, none of that happened. On that positive note, my name is Raul. I'm the Coaching and Education Coordinator here at Trading Winds. The reason you're here today is to hear from our head trader, Vince Mora. Vince will be on shortly. I want to make sure that you can hear us and see us correctly. If you can, please let us know by putting in some kind of affirmative note in your chat box, and then we will get started with the session. Vince, good morning to you. While I'm waiting for the affirmative notes to come in. Thank you, Gary. Thank you, Jen. Thank you, Leonard. Thank you, Flynn. Thank you.
Good morning.
How are you?
I'm great, thank you.
Good to hear. No, good to hear. Yeah, as soon as we got on, you said, "Boy, the markets are."
Well, it's nothing overly dramatic, but it is compared to most days that we've seen recently. So it's selling off a little. Financials are getting hit, down about 2%, and the Dow is down almost 200 points here. So it's going to be interesting to see where it closes. That's what really matters.
I see one of your many screens is tuned to the CNBC website.
Mm-hmm.
How fairly do you think they report the news?
Oh, well, I think they're totally fair. It's just a matter of guessing more often than not. In other words, I mean, obviously, something like the financials dropping 2%, that's pretty obvious. Is that really the only reason for the market pulling back today, or is there a bigger reason? That's what we don't know. So, when you listen to media outlets like CNBC, they'll give you their opinion. Some days they'll say it's due to crude being down 2%, but then other days crude will be down 2%, the market will be up 200 points. So it really doesn't matter. At the end of the day, the charts tell you everything. So that's really all you need to focus on.
Do you find correlations different now than they used to be when stocks were down, gold was up?
Yeah.
That was almost a sure thing.
Completely different. Yeah.
And how has that changed over the last 10, 15 years?
A lot of the correlations that have worked for the longest time just aren't working like they used to. But there are always periods of time where they kind of go out of whack and then they come back in line. And before the markets were a lot different. I mean, even I remember, 10, 12 years ago when the Fed was about to announce whether or not they were going to raise rates, the whole market would kind of stall. And then the hour after the report, the market would just be crazy. We no longer see those kind of reactions anymore. So things have certainly changed. But luckily, when it comes to technical analysis, everything remains the same pretty much. So we'll be focusing on that.
Excellent. A couple of other people that have joined us, and call out a few names who responded to the affirmative note for the chat box. Arnold, Charles, John, Penelope, Gary, Thomas, Dennis, Ken, Phyllis, Alan, Carolyn, Matt, and Ron. Get to the rest of you throughout the session. If you have questions, please put them in the chat box. At an appropriate time during Vince's session, when he takes a break between segments, we'll certainly get to those questions and do our best to get to each and every single one. Vince, magic of chart patterns. What's so magical about chart patterns?
Excuse me. What's great about chart patterns is they repeat themselves. In other words, they can be relied upon some more than others. But over time, regardless of whether you're talking, 80 years ago, whether you're talking 10 years ago, or you're talking last week, these chart patterns work over and over again. It really is, they develop out of human behavior, and that's really the bottom line. And human behavior really doesn't change much. So what your job as a trader is to be able to spot that pattern ahead of time if possible, and then act on it. And do so in a way where you're protecting yourself while you're allowing yourself to take advantage of any move in your favor. So that will be the focus of this class.
Well, let's not waste any time. The session is being recorded, so it will be made available to you for later viewing as well in case you need to leave during the session. I think that's all the admin stuff, Vince. Off you go.
Excellent. I'm just going to grab a sip of my water and we're going to get started right away. Okay, so this is our pro class for our chart patterns. I do want to show the disclaimer and remind you that trading can be risky. So please don't trade with real money unless you're completely comfortable with the system you're using. I'll skip the poll question here. Today's presentation, I am going to review the same items I did in the last class, but I'll do so very quickly. In other words, we'll go through, what technical analysis is and what you need to know when it comes to technical analysis. And then we're going to focus on the 7 charting patterns that I promised you. And hopefully we'll have time to answer all of your questions as we go through this. So when it comes to technical analysis, I'll leave the textbook definition up there for a second. You can go back to the recording and go through it. But as I mentioned earlier, the real focus when it comes to technical analysis is using the right tools and understanding that it really is a reflection of human behavior. So, that the greed that comes in, right? The panic that sets in sometimes. It's a cycle and it repeats itself over and over again. And the charts really tell a story, and that's what you really understand. Now, in order for you to be able to read charts accurately, you need to understand these 3 things. One of them is price action, and we'll expand on this a little in today's session. Same with trend lines. We'll go a little deeper into trend lines, and then, of course, those charting patterns. Okay, so price action, as I mentioned last time, really is what we use to make sense of the back and forth in the markets. Today's a great example. I'm really happy the markets are actually moving today because we're going to bring in some lower time frame charts like the 1 minute and the 5 minute and really look at this morning's session and see if we can spot any patterns on there, because it's been a really nice strong trend to the downside this morning. And I'm sure the chart will tell us something. So we'll look at that. And just going back here for a second, one of the most important parts of price action are the swing highs and swing lows. In other words, what we call pivot points. So we'll focus a bit more on that. But let me just reiterate what the basics are of price action and how you should read a candle. Now, I am going to be using Japanese candlesticks for this, but even if you use open, high, low, close bars, it really doesn't matter. It's the same sort of thing. So just a quick refresher on candlesticks. Most charting platforms use either white or green candles for bullish candles and either black or red for bearish. The real reason why they're painted those particular colors are all based on the open and the close. In other words, if a stock closes higher than where it opened, it's going to be painted in either white or green, because that's bullish, right? We closed higher than where we opened. On the flip side, if we close lower than where we opened, that's bearish. That means sellers won that battle, and it will be either black or red. Okay? So what you need to understand is that the open is always going to be at the bottom the bottom edge of the body, if it's a white or green candle, and the open will be at the upper edge of the body if it's a red or black candle. Now, if you're using open, high, low, close bars, the open is going to be on the left side of the wick, the little line, and the close will be on the right side. Okay? So you can tell based on where those appear on that wick whether you closed above the open or you closed below the open. Okay? But fairly easy and simple to read. So what it really means is we opened here, sellers managed to drive it as low as here, then buyers stepped in, brought it all the way back up here, and then sellers put a bit more pressure on and we closed over here. So by the end of this session, we could say that buyers won this battle. Each candle or each bar is a tug of war between buyers and sellers. And you always need to be able to answer 2 questions. One, is who won the individual battle on that particular candle, and it doesn't matter if it's a 5-minute, a 1-minute, a weekly bar, a monthly bar, it doesn't matter, and who's in control overall on the chart, meaning over multiple bars or candlesticks. Okay, now there's different types of candlesticks that you're going to see, or bars, and when it comes to Japanese candlesticks, each of them have a name. We're not going to focus on the names. The names don't matter. What matters is that you understand the significance of it. What does it mean? So if you look at a bar like this, the white one here, it's a very wide range bar, but you read it the exact same way. In other words, we opened at the bottom of this body. We went as low as this point here on the tail. We went as high as this upper point on the wick here, and then we settled up in here at the upper edge of that body. So overall, it's very clear that the buyers were in control here. And this carries a lot more significance than this smaller candle on the left. The left one you would read the exact same way, and if you read it that way, you could say buyers won this battle as well. But the one thing that you can take away from this, based on the range from high to low, is that, was this much of a battle? It really wasn't. There was a very tight range. So there was not a whole lot going on there, back and forth. As we're here, there was a much bigger battle that took place. And the fact that buyers managed to take this all the way up here means that they were firmly in control here, as opposed to these dark candles you see on the right side. Again, the small range candle, not much of a tug of war. You can say that sellers won this battle, but it wasn't much of a battle as compared to this candle here, where yes, you can say the sellers took control here, but it was a lot more significant because of the size and the range from high to low. Okay, now these types of candles here, where there aren't even any wicks or tails. In other words, we open at the low of the day and we close at the high of the day. That means that buyers were firmly in control here. And this is about the most powerful candle or bar type that you're going to see out there. When you see these, you need to pay attention to these candles, because this is very powerful. And usually when a candle, when a candle closes in the upper 25% from the high here, okay, and there's usually a continuation. In other words, it continues to trade in that direction. But when it closes right at the high, the odds are even higher, much, much higher, and it's just going to continue going that way. So more often than not, when you see a candle like this, you're going to see follow through, okay? But not only is it important that there are no wicks or tails here, that it opened at the low and closed at the high, but the range, once again, matters. So the longer this candle, the more significant that would be, okay? The bigger they are, the better. Here, the black candle, same thing, it's just bearish. So sellers, we opened up here at the high and sellers drove it all the way down all day, or throughout that whole 5-minute segment, whatever time frame you're using, and it closed at its lows. So very, very bearish bar. Most likely we'll see continued selling in future candles here. And the wider the range, in other words, the longer this is, the more bearish it is. Okay? The complete opposite of that are what we would call dojis, or spinning tops. Now the names don't matter again, but what matters is that the range is there. In other words, there was a significant tug of war going on between buyers and sellers. They were able to drive it all the way up here, all the way down here, back and forth, and then we settled somewhere, near the open. In other words, here, buyers won out, but can you really call it much of a win? Because you had this huge battle, and we closed just slightly higher than where we opened. Same here. So these here, when you see these types of candles, it's sort of a red flag. It's sort of a warning that there's a potential reversal coming. You will normally see these types of candles at either the bottom of a downtrend or the top of an uptrend. these usually mark the turning points. Why? Because imagine if you were getting, higher highs and higher lows, and buyers were firmly in control all the way up here over several candles, and then you get this type of candle. What does it mean? It means now that sellers are putting up a much bigger fight here. It's a big tug of war, but sellers are almost as strong as the buyers, right? These candles to the right are what you should consider indecision type bars. You will also see these at turning points, like at the bottom of the downtrend or at the top of an uptrend. But these are what we call indecision battles. In other words, nobody won this battle. Okay, we opened here, we went as low as this point, as high as this point, and we closed back in here. So we closed where we opened, or very close to it. And there was a very small range. Okay, so number one, wasn't much of a battle at all. But number two, no one took control. The buyers were not in control, the sellers were not in control. So this is completely an indecision type candle. Usually when we see these, it's just a heads up that, hey, maybe that uptrend is running out of steam, maybe we'll roll over, but we have to wait for the next candle to really confirm, okay? And so let me, before I talk about trend lines, go to the charts and give you another example. So if we look at this run here, like we did the other day on the Dow Jones, okay? Back in here, sellers were in control, okay? Number one, you would ask yourself, who won this battle? Okay, clearly sellers won this battle. Not only did we close lower than where we opened, but it was a fairly decent sized candle, decent range, and we closed lower than yesterday's close. So again, buyers in control there. Next candle, not as bearish, it's much more of a tug of war going on, much smaller body here, but still red, sellers still in control. Next one, we can say it's an indecision type candle, so we pause. But the next one, sellers clearly in control. So now we can say that not only are sellers winning the individual battle, but they're in control now overall. And we continue with that path until we see a close above the previous candle's high. That's signal number one that we may be turning around, okay? Now, not only did we see that, but we saw a huge gap up. And not only did we gap up significantly, so the open was way higher than where we closed, but then buyers continued to step in here and close this much higher than where we opened. So overall, if you look at the distance from this close to this close, it was very significant. So now buyers instantly have taken over here. And now our focus is reading candle by candle to determine how long we should stay in this trade, okay? So the next candle, what do we see? We see a higher low than the previous one. We also see a higher high. And it's another decent range. And again, buyers closing this much higher than where we opened. So not only did buyers win that individual battle, but buyers are in control. Next candle, we actually open lower here, but buyers step in quickly and drive it all the way back up. So now, not only are buyers in control still and won this battle, this is a huge candle which carries a lot more weight, a lot more significance. Okay, so now they're firmly in control. And we just continue on and look at this. So if we see this candle here, did buyers or sellers win this battle? Obviously, we opened near the upper edge of the body, went as high as this point, low as this point, and settled in here at the low, which was lower than where we opened. So with that, you can say sellers won this battle, but they actually did not, because we actually closed above yesterday's close. So we still continue on with higher lows, higher highs. Buyers once again won that battle and are firmly in control. And we continue on that path until we get a close below the low of the previous candle. We actually got that one here. And yes, this was an indecision type candle, but we closed below the previous low. So it was a red flag. Whenever you get that, you want to mark that low of that candle here. And if you were to get a trade below that, that would be your exit. In other words, your trailing stop would go right here. Okay. But instead of sellers being able to take that below that point, buyers stepped back in. So you would actually not exit there. You would once again remain in and wait for another signal. Now, we go all the way up to here before we see another close below a previous low. So we mark that candle again. Did we trade below there? No, we did not. Buyer stepped in again. So we continue on. Then here, this candle closes below this low. We mark that. What happens? Buyers step in. And we go. Now this candle here, we close below the previous day's low. We mark that. And the very next day, sellers continue selling and we exit. So you could have, taken this from down here all the way in here. Okay. Now, you don't necessarily have to jump in on that first candle, and you can follow the rules of any other strategy with indicators and so on, whatever you like. But once you're in that trade, once you enter wherever it will be, whether it's here or here or here, really doesn't matter. But once you're in that trade, if you follow along candle by candle, it'll keep you in for the bulk of that move. So that way you can protect yourself with a stop close by without limiting your upside. Okay? So very, very crucial there. Now, let's look at one other quick example here. And let's look at the chart of crude oil. And we'll do so on a weekly. I'll do so fairly quickly here. Remember when oil used to be at 100 and then started breaking down? Okay? If you followed this move exactly like I just described, okay, you would have been in this move up until this point here. Okay? So you would have been in the bulk of the move. And whether you took that trade on the break of this previous low or any other, using any other strategy, you can see that you catch more than 80% of that move just by reading it candle by candle. And that's the real key. Okay? So any questions on that before I move on to trend lines? All right. So in the interest of time, I'm going to keep going. If there's any questions and we see them come up, Raul will interrupt me and we'll answer that for you. Okay? So let's talk about trend lines now. Actually, let me just briefly go back to the slide for a second. And remember, these do two things. Not only do they help you identify trend and confirm it, but more than anything, they help you identify areas of support and resistance. Okay, that's the key with trend lines: support and resistance. So, if we look at a chart like this, MAR, and I'm going to go to the monthly time frame, but the monthly time frame isn't what's important here. You can have a 1 minute, 5 minute, doesn't matter. You can be looking at a Forex pair, futures contract. It's all the same. The only thing you need to be able to identify is where are the pivot points? Where are those swing highs and swing lows? So these here are the pivots. Right here, here, here. So anywhere, these turning points. How do you identify them? If you look at the candles, for example, and you're getting, so let's look at this section. I'm going to zoom in a very small section here. Okay, what's happening here? Actually, let's start from back here. What's happening here? Each candle is making a lower high and a lower low. Now, sometimes, like this, they might do one, but not the other. In other words, lower high, but not a lower low. But it's just a smaller range. Okay, but remember, as long as we don't violate the previous high during a downturn, or we don't violate a previous low during an uptrend, then it's just a trend in that direction. So here we continue to make lower highs, lower highs, lower highs all the way through. Then suddenly we get a higher high. So this high is higher than this high. Okay? So we saw that turn. Now, what we need to confirm that this down here is the pivot is we need to trade above this high. So in other words, when you initially get that turn, where you make a higher high than the previous candle, and then there's follow through, and here it happens on the second candle, not the first. Once you get that, this here, the low of this downward move becomes the pivot. Now that we have an uptrend in place here, okay, and why do we have an uptrend? We continue to make higher highs. See, on this one, we didn't make a higher high, but we didn't make a lower low either. Higher high, now higher high. Okay? Lower high, but we didn't make a lower low. Higher high. Okay? Now, lower high, but not a lower low. Same thing here. Suddenly we breach that low here. Okay? So once we see this and we turn, this is now going to become the next pivot. And the lows are known as pivot lows, and the highs are known as pivot highs. Okay? So you want to identify the major pivot lows and pivot highs. And on a chart, very simple. It's these tips right here. Okay? So those will determine future levels of support and resistance. So let's look at this. If we go back and we take these low or these highs and low pivots, and we just extend a line up here, look what happens. Okay, let's take these. So if we go back here to July of 01, many years ago here, and nothing had happened since. If it was July, August, September, October here, and we had put in this pivot, once we confirm that pivot, you just draw a line and keep extending it out. Same with here. Just these 2 points alone, these 2 pivots, look at how many other times in the future we went to touch and retest these levels. Even here, when we move from one pivot to the next, we bounced off it, then we broke through. Okay? We came back here. Once we came back, we bounced around a couple of months, then we broke through. Where did we go to the next level? Bounce around and moved higher. Then we bounced around here and jumped. Came back to retest it, bounced. And then the more times it touches that line, the stronger that level becomes of either support or resistance. Okay? So it's crucial that you recognize or you look back in your chart and identify these points. Now, you don't just have to extend them out. You can connect them, okay? So, in other words, if we were to connect these lows here, this low across these lows here, and extend it out. So we hit here, 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 okay? Yes, what's that known as? Drawing a trend line. Well, why is it important? Because once we had 2 points to draw this on, all we needed were the first 2 points, this one and this one. And we extended that line out. Now we know where there will be support. And so if we were following this and we saw a retracement, we knew exactly where there would be some support. So all we need to do is wait for that signal, that reversal signal. Okay, let me zoom in, and you can see here, come in here, and suddenly we get this, the buyer stepping in, right? Sellers come in, buyers step back in here and bounce it up. So it's very important. And if say it had come in here, price had moved higher and retraced back to here, for example, where both the horizontal and this trend line meet here, that's an even stronger area of support. Where the lines cross, that's an even stronger area. So had it pulled back in here, and then the buyer stepped in for one candle like that, that was a very good, strong indication that this was going to move higher. Okay? So just by simply drawing these lines, let me zoom back out and keep showing you what happens here. We can connect the tops of these down here. What does it show us? Not only does it show us a breakout when this closes above that trend line, but look what happens next. We run into this horizontal resistance, come back, hit this line again, find support, and bounce. Now, what happens next? We break through. So where would we get to if we broke through from one level to another? The next level of support or resistance, which we would be where? Another pivot high, which had we drawn this line in here, when this pivot happened across, we would know where the next potential area of resistance would be. And you can continue on, excuse me. And so in other words, when this pivot happened and was confirmed, we extend the line across. Well, look what happened. We come back here, bounce. Where do we go? The next one, and bounce, right? And it keeps happening over and over again. So it's something so simple, but yet it's something extremely effective. Now, you don't have to extend these lines over and over with every pivot and keep all of them on your chart, because it's going to get a little messy, obviously, over time. But, excuse me, when you're about to take a trade, you want to look to your left, find these pivots, and draw lines to see where are the future areas of resistance. Where could your trade run into some trouble if there's resistance? Or, better yet, is there support behind it? So in other words, look at this area down in here, okay, where there was this previous pivot where we drew it across. So let's say that it looked like we wanted to take a trade in here. Now, if we were going to go long in here, and we knew we had support immediately right behind us, that would be a good thing. Why? Because when price approaches a level of support or resistance, it more often than not bounces right off it, which is great. So in other words, we have security here for our long position. But even if it doesn't just immediately bounce, it usually kind of bounces around there for a little while. That will give you time to get out of the position if you don't believe it has enough momentum to continue going higher. So the more levels of support there are behind you, the better it is when you're about to go long, and vice versa for a short. The more areas of support above you when you're about to go short, the better it is. And obviously, the fewer points of resistance overhead, the better. Okay? So this one, we would have drawn a line across, and we would have said, yeah, if it clears here, well, it's going here. So from 43 up to 51, there's really no resistance. So now we know, wow, that's a pretty healthy move, 43 to 51. An 8-point move, yeah, I can make money on that. Okay? When you look above here, once it broke through here, where's it going? Next level of support. Well, is there or resistance? Is there? No, at that time, it was an all-time high. No resistance up ahead. What happens? It just keeps going. Okay? Now, I'll show you another trick how to measure that target, but this is absolutely crucial. Okay? So you need to know how to draw trend lines, and you need to use them. But really, all you need to do is either connect different pivot points or extend the line across from each pivot. It's that simple. So here, when it was pulling back, if you want to know when it's about to turn, you have a support level here. You know that from way back in here. But if you had connected the tops here, drawn your line across, that breakout, this is when it would tell you that, hey, it's really turned the corner. If you don't get some other sort of signal. Okay? And so you can draw lines all over the place. You can even draw them, say from here to here and extend it across. Okay? And you'll notice that when price moved up here, it came back here. Now it had multiple support lines. Okay? You can draw using the wider ones like this here. At some point, this line is going to be a future area of support. So if price turns around and comes back, it'll find support there. If you attach this top with this top, you can say, well, that's going to act as resistance. And we're pretty much there, aren't we? Okay? So that's, it's extremely important. And it won't take you very long if you just go through charts and just draw from point to point. And look, if you can draw multiple points, the better. So not just 2, but if you can draw 3, 4, etc. across, the more important it is, the more significant that level of support is. So in other words, if you only have these 2 points here for this line, then yes, it would be resistance, but it wouldn't necessarily be strong resistance here. But if you have 3, or if you had 4, 5, the more points that you could attach to the same line, then the stronger the likelihood that when price approaches this, it's just going to bounce off it because it can't penetrate through that much resistance. Okay? Any questions on that? Very, very important. It looks like everyone's clear on...
Either that or they're being distracted by the markets on what's happening on one of their other screens.
Yes. Well, we can start looking at that with the chart patterns. Okay? So, if there isn't any more on that...
There is a question from Glenn.
Mm-hmm.
How important is price action, or the analysis of price action today than it was 10 years ago? Is it different now?
No, it's exactly the same. That's the beauty of it.
So even with institutional traders or high-frequency traders, that analysis has not changed?
No, it hasn't. So what you're going to find with institutional or high-frequency is that there will be computer-generated buy programs and sell programs. So what it means is you'll see a lot more of these spikes. So if the computer's programmed to buy on a break of this high here, okay, and then it's got a specific number of shares that it has to buy, and it's just going to blow through the offers one after the other, and it's going to continue driving this up until it's picked up all the shares at once. Okay, but if you're in this stock and that's happening, and you're reading price action the way I showed you, candle by candle, you're going to remain in this move until that program stops buying, because that's the only time you're going to get a red candle showing in here. So you can take advantage of it just the same. Price tells you everything. Trend lines, other chart patterns, other indicators, those are all tools that we use to further confirm what we're seeing on the chart. Otherwise, you really do not need anything other than price to trade with. Okay, but those tools can be helpful in different situations. So let's start going through some of those.
There is one more question.
Sure.
How often do you get faked out by price action?
Nowadays, not as much anymore. There are times I do, not as often. But when I first started, it used to happen all the time. The reason was I wasn't reading it correctly. So in other words, you know, when for example, let's look at this area in here. Okay? So if I had gotten into a trade down in here and it started going my way, and let's say that by the time it got to this red candle, I had a decent profit in, and then I saw this candle, I'd immediately start questioning myself. You know, should I get out and keep my profit? Because if tomorrow this opens lower, I'm going to give up half my profit, and you know, blah blah blah. That's the kind of mental exercise that I go through, that I put myself through, and I would always question myself. And what I would end up doing here is notice how the green candle opened down here. It actually opened below where this candle closed. So as soon as it opened there, that next morning, I'd be in full panic mode and be like, oh, here we go. It's going to go against me. And I'd sell out, only to watch it the rest of the day just go back up higher and then continue going higher. And then kick myself and blame myself for not being able to stay in there. Okay? If you really look at this, what is that candle telling you? It's nothing more than an indecision candle. Nothing's changed. Uptrend is still in place. A previous low has not been violated. So you stay in and you stay in and you stay in. Here, a previous low was violated. Now, you mark that low. What happens the next day? It actually trades below there. So you exit. Okay? Doesn't mean there can't be more upside, but you exit. So if I had gotten in here, from here to here, I would have taken a nice profit. Okay? Now, Next candle, it goes even lower. I'm thinking, I made the right decision. Thank God I got out, saved my profit. Then the next day, boom, big move. Now, instead of saying, oh no, what an idiot I am, I could have held on, all I have to do is say, is it time to get back in? Mark the high of this candle. There's that move. Maybe I get back in. And maybe I get taken out right away. But even if I do, look, even if I were to get back in here, and then this candle closes below this low, and this follow through and I exit again, okay? How big of a loss is that? Very little, right? Then it turns, get back in here, and now we're talking, now it moves. So what you're going to find if you read it this way is your losses when they happen are going to be very, very small. Okay, the odd time you'll get caught if there's a big gap with news overnight or that sort of thing. But if it's during the day trading, you won't get caught that way. But what you'll find is that you're in for the bulk of that move when it happens, when it goes your way. So your winners are going to be huge compared to your losing trades. And that's how in the long run, you're going to make a lot more than you will lose. Okay, all right. So everything good to move on?
Yes, let's move on.
All right. So let's start talking about chart patterns. Now, last class, I went through the cup and handle and the double tops and bottoms. So I'm going to quickly go through those one more time, and then I'll go through the other 5 for you. Okay? Now, let's look at IDRA, and I want to use IDRA. We talked about this, I think, in the video last night or the night before. I can't remember when it was here. But here, with the cup and handle, I want to show you this just to show you that the price of the stock doesn't matter. This is what I would consider a penny stock. It's under $5. Okay? And you can still see a cup and handle just like you would on something like a Starbucks or on a Forex pair or anything else. If you focus in on this area, you look at this high here, and you make what we call a fairly rounded bottom here, and you get back to that high, and then you pull back again. So this is the cup, and this is the handle. Okay? So where's your breakout? It's on the high here, high edge of the cup, after you complete the handle portion. So this green candle here is your breakout. Okay? But this is your breakout level. Now, a couple of things you can do. Number one, as you're partway through this, you can tell that, you know, and some have a nice, much nicer shape, a much rounder shape to it. But regardless, the whole point is that we were selling off, and now we've turned the corner, and we're heading higher. And you want to keep an eye on here. And if you had drawn your trend line across, you would know where that high is and where you're about to run into some resistance. If I take this across, it'll show you. So we got up there, right? And look, you could say, hey, this green candle broke through there. So at the time, it looked like a breakout, right? But remember, you have to wait for confirmation. So what's confirmation? Confirmation is a trade above the high of that bar. Did we ever get it? No, we didn't. Okay, so you would not have taken that breakout. And now we start pulling back. Okay, now this time, because you've extended this line, you know you've blown through a layer of resistance here. So where are you likely to go? The next. But this is telling you, based on the size of this candle, how strong the buyer stepped in, that, hey, we're likely to break out again. So that's one heads up. Another along the way is that you may see a different charting pattern. Like, for example, in this case, a reverse head and shoulders. So you could say you have shoulder here, you have the head here, okay? And then you have another shoulder in here. So how do you confirm a head and shoulders breakout? Well, you take the highest point between the two shoulders, which was in here, okay? And you take it across, okay? Now that's your breakout. So you break out, you follow through, there's a trade above the high, you continue going higher. What happens next? It pulls back, but that's support. It holds it, pulls back again, that's support. This time it takes off. Now you know based on that, A, you could have taken that trade if you were watching this pattern, but B, you know that it's more than likely going to get to this high, which means it's going to complete the cup portion. Now when it starts pulling back, you know you're in for the handle. So you can then take your trend line and look for an early sign that we may be breaking out. So you attach the tops of these candles, and this candle here that gapped up was your heads up that, hey, we're probably headed for a breakout cup and handle. As I mentioned the last time around, you can attach higher points here across for a heads up on a potential breakout above there. So you can potentially get in earlier. So again, drawing trend lines and then looking at price throughout, because through here, you could have been reading this candle by candle and asking yourself who's winning the individual battle and who's in control overall. So buyers were in control overall here. Okay? Sellers were in control here, but then buyers stepped back in. So along the way, you understand where you are in this process every step of the way. And then when you overcome multiple areas of resistance, all hovered in one area, and you do so strongly with big green candles, you know this is for real, and that you're most likely going to go up to the next area of support where you can find out where that is just by drawing your areas or extending your lines off the pivots. Okay? Very straightforward. USD CAD pair that I showed you last time on the monthly is a much cleaner looking cup and handle. Regardless, it works exactly the same. Okay? Very simple and easy. Double tops and double bottoms. Last time we looked at NVIDIA. Let's go back to the daily chart here. Remember, what you need, what you're really looking for to confirm this is obviously you need two tops in and around the same area here. And then you want to identify the lowest point between those two tops. And if that point is violated, then this pattern is confirmed. Now, an ideal double top would be you get this spike here, and associated with this spike, there would be some pretty significant volume. Let's see if we can put on volume here for a second. Okay. So was there a volume spike with this? Yes, there was, right in here. Now it starts pulling back, then it starts making its way back up. Once it gets there and stalls, okay, and you want to look for some kind of bearish sign that this resistance level will hold, and you got it right here, where you went from making, actually let me zoom in, you went from making higher highs and higher lows to getting a move below a previous low with follow through and a big red candle there. And what else did you have? Another spike in volume that was slightly less than the previous one. What would have been even better here, more of a textbook case, is if this move higher ended just shy of this level. So if the second spike is a little lower than the first, and the volume spike here is higher than average, but it's a little lower than this spike, that's the ideal double top. Because it means that buyers are now running out of steam and sellers are taking over. Then you mark this low, the lowest point between those two highs, and you wait for a close below there, not a trade. You see how this one traded down here, but it didn't close down here. But then this one did, and there was follow through. At this point, it's official. Now, it's not 100%. They're not all going to work. But if you took this trade, if you went short here on this follow through breakout, where would your initial stop be? Where it could be just above this area of support, which now becomes resistance, or you can put it at the nearest pivot, whatever makes more sense. Obviously, this one is too far away. You're taking too much risk, so you can put it right over here. So if it's not going to work out, like in this case, I'm going to turn on you, it's a very, very small loss. But if it had worked out and had taken off, it would have went to the next area of support or resistance, right? Wherever those pivots were. But if it did, that winning trade would be much bigger than that losing trade. And that's the important part here. Okay. Now that it's gone back up in here, you're still going to extend these lines out. Okay. But now it looks like we may be in for a bit of a channel. So this may bounce around a little until it breaks out one way or the other. Okay. So you can keep an eye on it. But that's basically the double top formation. Double bottom formations are the same sort of thing, only backwards. Okay? In other words, you get a spike lower. Let me see if I can find one here quickly before we move on. Let's see. Let me check. Yeah. Look at this one in here, more or less. Okay? So you have the spike lower. You get a high volume spike in here. It attempts to move higher, then pulls back. You get slightly higher than average volume, but lower than the previous spike. And now you identify the highest point between those two lows, and you wait for a breakout. Once it breaks out, it's confirmed. Okay? Now look what happens. It jumps and comes back. Where does it come back to? This previous pivot point. It finds support right here. If you miss the breakout, it usually retests that same level or somewhere nearby, a level of support. And at that point, you can look at getting in, okay? And then it's a matter of managing that trade. But it works the exact same way, just in reverse, okay? And you'll get clues based on reading the candles one by one, okay? Even look, if you look at where these were, back in here, and look, this point extended out is exactly that level. So we knew on this first pullback that we could see a bounce at this level. Once we did, but we couldn't get as high as here, then you're looking for another retest. If it holds it, now you're talking double bottom. You can also use tools like your fibs, right? If you take your fib retracement tool here, and let's say it came back to this level of support and started to bounce, you could say, is this a proper fib level? Go low to high, and yeah, it came right back into the 61.8 and bounced. Okay. The Fibonacci tools identify areas of support and resistance for you, and so any pullback into this zone of 38.2 to 61.8, this is all support here. So getting a bounce from this area is very, very positive. And you can see how well that trade worked out. Okay. So double tops, double bottoms, you see them everywhere, especially these days. Keep an eye out for them and try not to jump the gun, but they're very easy to spot after a while when you train your eye. Let's have a look now at head and shoulders. Okay. We looked at one already. Let's look at a couple more, and then we'll go through some less popular charting patterns here. But let's look at VRX. You know VRX.
I am familiar with it.
And let's go to the weekly time frame here. Look at what we had up in here just before the big collapse. So VRX went from being a $260 stock all the way down to a $10 stock. Was there any heads up here, any clue that this was coming? Well, if we look at shoulder, head, shoulder, take the lowest point between the two shoulders, which was here, carry it across, there's your breakout point. Then it's a matter of reading it candle by candle. And this entry here would have taken you all the way to here. So this was from the $200 range. You could have been in until 91. Okay? So more than 50% loss there would have been a gain for you. Okay? But $110 move there. Now it retraces and starts to move back lower. If you just mark these pivots, right? There's the next breakout. And the rest is history. Okay? So you can use, again, not just price action, but trend lines and charting patterns together. Now there are other patterns in here wedges, descending triangle, which we're going to talk about. Okay, then these are all in here. But if you just train your eye and look for these, and it starts with you reading candle by candle, over time, it's like they'll just pop off the screen for you. They become very visible. Okay, so when you see this, the other thing to know about a head and shoulders pattern is how do you judge or where do you put your target? In other words, how big of a move can you expect? Well, one of the things you can do is measure the very top of the head here to that lowest point between the two shoulders. So if that is, see, this was from about 265 up here at the high to 200. So about a 65-point move. So what you would do from your entry is go down about 65 points, wherever that would be, somewhere around here. Okay? And that would be what you expect. Okay? Now, if the bars are still telling you to stay in after that, you still do so. But along the way, you could be scaling out. You could say, hey, I'm expecting a $65 move. Maybe I'll sell a third of my position after $20. I'll sell another third after the next $20. And then I'll let the other one ride up until the candles tell me to get out. Okay? So that's always a smart thing to do because you never know when there's news out and this thing gaps higher. Then it just turns around big time on you and takes away all your profit. So it's always a good idea to scale out if you're trading with multiple shares or option contracts. Okay. Any questions on that?
Louis says, I'm a swing trader and use daily charts for spotting patterns. Should I keep using daily charts, or would it be good practice to also check the weekly and monthly charts?
Louis, for your practice, the weekly and the monthlies are much smoother. So just make sure they have enough history. But you're going to see clear patterns on the weekly or the monthly. So as you're learning, you want to start at the highest time frame and work your way lower. And then as you gain more and more experience, you want to continue to lower your time frame. Now, you should always trade the time frame that's comfortable for you. So in other words, if you're not able to sit in front of the screen and you only trade, you only look at your charts in the evenings after you're done work, for example, you want to use daily charts. You're not going to use a 1 minute or 5 minute that way. It's not going to be possible for you. On the other hand, if you're a day trader, you want to work your way down to a lower time frame chart, like a 15 minute or a 5 minute or the 1 minute. But I'm going to show you as we go through here that the same patterns show up on all time frames. Because of the smoothing out effect of the time factor here on the monthly and the weekly, it just paints a much clearer picture. Okay? On the daily, there's going to be a lot more back and forth. So it's going to be a little harder spot, but definitely the weekly and the monthly for practice. Okay? So let's see, how are we doing for time? Pretty good, actually. I'll show you one more before we move on here. If you look at MU and look at the weekly, okay, there's a double bottom here. Breach this midpoint low, or high, sorry, and look, it even acts as a level of support once you breached it. You broke through, came back to retest it, and then just took off. Okay? When you see this and it starts taking off, you look for previous highs here, and you look for a move somewhere into that, right in here, and then what did we have here? That completes the cup. Here's the handle, breakout. Retest, boom, off we go, right? Multiple patterns in this one move. Okay? Had we connected some dots here, pivot to pivot to pivot to pivot, we knew this was going to turn around right in here. We knew it had put in a bottom based on this. It came back to retest that same bottom and held. Okay? Now, based on this candle, you know there's a high probability it's going to break out and confirm double bottom. Then you take it from there. You mark your lows and high pivots, and you know exactly where your resistance levels are going to be. Okay? Step by step. Just take it one step at a time here, okay? Again, head and shoulders pattern, they're not all perfectly clean, but it's a pivot, a higher pivot, and then a lower pivot. And what do you do? Mark the lowest point between those two shoulders and keep an eye on it. Drag it across. Look what happens. Price comes down, bounces around there for a while. When it breaks out, where's it going? Next pivot. If it blows through that, where's it going? Next pivot. Exactly. But once you get that breakout on the head and shoulders, what do? Measure from here to here, and that's about the same distance move you're going to get. So we'll call it 36 for round number to 26, a $10 move. So from 26, where can we expect to go? 16. Did we get there? Yes, we did. Okay. So you'll be surprised at how well these work. Why? It's all based on human behavior. Okay. Let's look at a different pattern. Let's have a look at island reversals. Island reversals are one of the most powerful charting patterns out there. Okay. Let me show you a couple. Let's see. I think there was one on the daily here. Yeah. So have a look in it down in here. An island reversal is where you get a gap down followed by a gap up, or the other way around. So in other words, there's a gap and a gap, which means these candles here, these are all left on an island of their own. Okay? That's a huge reversal signal. When you get a gap down followed by a gap up like that, and the bigger this island is, the stronger the move should be. On that gap candle, you mark the high, and if there's follow through, if there's a trade above that high, that means you should be off and running to the upside. Okay. So now if you look at these candles here, we had a huge gap up. If we were to gap down, if you now get a candle that looks like this here, green or red, it doesn't matter, but a gap up, gap down, that leaves these candles on an island of their own. So you would mark the low of this candle, and if there's follow through, if there's a trade below that, that means this should go substantially lower. Where? Well, you mark your pivots, you know where your support zones are, and you know where your targets are. And if you have other gaps to target, you know gaps will always eventually fill. So this may come as low as down here to fill this gap. Okay? Now you know exactly what to expect from here. Okay? Let's see if we can find a couple of others. I think Costco has a lot of gaps. Yeah. So here, and sometimes the gaps are quite small, but there's a gap up here, gap down here. That leaves these candles on an island of their own. So when you get the gap candle, you mark that low. The follow through doesn't happen for the next two candles, but on the third it does. Trades below. Where does Costco go? It goes lower, right? Now, let's get rid of these lines. What happens? We had a gap down here. We have a gap up here. That leaves these on an island of their own. There's that gap bar. Once we breach the high, we're off and running, okay? So sometimes, like in here, you'll get stopped out fairly quickly. You jump in, it reverses right away. You could see, you can always use that level, see if you get a retest and then a bounce, but the point is that when you get taken out like that, the losses are very small. If you're looking for a system that's 100% accurate, you're going to spend the rest of your life looking for it, and you're not going to find it, okay? Trust me, I've spent 30 years looking. So don't shoot for 100% accuracy. Shoot for being 100% accurate with following your rules. In other words, do what the chart tells you to do. If it tells you to get in, goes up for one candle and reverses on you and tells you to get out, then get out. Take that small loss and wait for another opportunity or another signal to either go short or go long, okay? And you will find the strategy or the pattern that you prefer, and then focus on being 100% disciplined with following those rules. Because in the long run, you'll have more winners than losers, and your winners are going to be much larger than your losers. You can't go wrong with that formula. Where you will go wrong is not following your rules, is staying in too long, getting out too soon, not buying when you should, but waiting and then buying after you've chased it for a while. Those are all errors that can be corrected. Okay? They have nothing to do with the strategy. That's all on you as a trader. So just follow the rules and you'll be totally fine. Okay? So the bigger the island, the bigger the follow through. Sometimes the island's very small, like up in here. Let me zoom into this area. Okay? Gap up here, gap down here. This is an island. Is your gap bar marked the low? Was there follow through? Did it continue to trade lower? Yes. So if you find that more often than not, when you enter on the breakout here, it tends to pull back right away and stop you out, then don't take that. When you see that island reversal, wait until you see the first pullback. Okay? And then when you see a pullback, when you see the buyers taking control, and then at that first sign the sellers are going to take control again, that's when you want to enter. Okay? Find your sweet spot. Find what works for you. What's easier for you to feel comfortable and not panic out and remain in a trade and take that setup, whichever one it may be. Okay? All right. We have a couple more here to get through. So, channels. Channels are great, actually. I love channels because they can result in some pretty big moves. So, here's one on JBT I had marked earlier. That's happening right now. What you need for this to be classified as a channel by the technical definition is you need 2 points on one end and one on another for it to be called a channel. So in other words, and you know, you can decide whether you mark the body of the candle or the wicks. It really doesn't matter. It's more of a zone than anything. Okay? But once you have at least 2 points on one end and one on another, now you have a channel, or just call it a range that the stock is in. And what you want to do is extend those lines and just wait for a proper breakout. By a breakout, it should be a close above or below one of those lines. But then you also need follow through. Okay? And you will get the odd time where, like this, you know, it closes below that line. Okay? And if you had used the wicks, it wouldn't have. So we probably, you know, didn't draw it exactly accurate here. But regardless, if this will happen sometimes, it'll close below that line. So you're going to mark that low, and the next day it's going to trade below there. If it quickly turns around on you, then so be it. But where would your stop have been? Your stop would have been just above that line. So in and out, very small loss. Now, what is this bar telling you? It's huge and it's bullish. That's known as a bullish engulfing pattern for those of you who might trade with candlesticks. And that's a classic reversal signal. Once you mark the top of that and it trades above it, where is it going to go if it's a channel? It's going to go to the other end of the channel. So if you were to take in that, you would have more than made up the loss 2 or 3 times over just on that move. And what you'll find with channels is that usually there's some very clear reversal signals. Like here, there was a big bearish engulfing setup. Here is a bullish engulfing setup. Okay? Look, there were multiple bearish engulfing setups up in here now that it's at the top. So you'll get some very clear bounces off these lines. But once it breaks through and there's follow through, what you want to do, so you can keep JBT on your list, on your watch list for a future breakout. But what you want to do eventually when it breaks out is measure the length of that channel. That's how big of a move you can expect in whatever direction that this breaks out. So if it were to break out to the downside, you know, a similar move would be probably around here. So it would give you a heads up that, hey, something significant is about to happen here. Okay? So those are channels. And they're awesome, especially if you focus on the low-priced stocks on the higher time frames. So sometimes you'll see on the monthly chart that stocks will consolidate for the longest time and then break out. Let's look at WIN here. We got another channel forming here. Okay. And now looks like we broke out. See how we had broken out here? We closed above the top, but there was no follow through. We never traded above the high there. We got another breakout, but this time we did trade above the high. It's happening this week. So now if we measure this channel, my mouse will work, there we go. That's the size of the move we can more or less expect, which takes us pretty much to these highs here. Okay. Now, along the way, this is a weekly time frame. Along the way, there'll be a lot of zigzags back and forth. Okay. So even if you don't get in here, you'll probably get other opportunities to get in along the way. But this is giving you a clear heads up of what you can expect in the future. What did you have down here? Double top, right? Broke the midpoint low and then took off. Then it went silent. Okay? But if you had taken this breakout, you would have been in for this move. Then reading the chart candle by candle would have got you up in here. Okay? Then you form the channel, breakout, off we go. Okay? One step at a time. This is going to take time. It's a process. Okay? You don't learn this stuff overnight. You know, like they say, you know, the 10,000 hour rule. To become an expert, you got to really spend time on it. Now, I don't think you'll need 10,000 hours, but the more hours you can spend looking at charts and marking your trend lines and identifying these patterns, the better you will become at this. Okay? Let's look at ascending and descending triangles. Okay? Another great pattern. Let's look at the S&P 500 chart here. Actually, let's not go to the weekly. Let's look at the daily. What I mean by ascending triangle is when you're in an uptrend, okay? So you can, let's say, connect lines here, and you're clearly moving higher. You got a nice uptrend in place. But when the stock or whatever it is that you're charting consolidates sideways, you can connect, you can have a flat top, more or less. If you draw these lines, you'll see a triangle. You'll have a flat top and then an upswing. So an ascending triangle looks like this. Okay? Descending looks like this. Okay? So here, you're looking for a breakout above that level and a continuation of that move higher. Here, you're looking for a breakdown and a continuation of that move lower. So, and you can spot these. They're everywhere. Let me give you a few other examples here. Let's go back to VRX where we were before. Let's go to that monthly chart here. Okay. Look at this area in here. We were moving higher nicely. Suddenly we consolidated sideways. There's our ascending triangle. There's the breakout. You mark the high of that bar. Off it goes. We follow it along bar by bar. Takes us into about down here. A move from 60 to about 120, 125. Okay, a double. 100% gain right there. Okay. When this pulled back and then turned, if we had marked this high, what's it telling us? Broke through resistance. Where's it going next? Well, there's no resistance up ahead. So if there's follow through, if we get in there, now we follow it candle by candle until the candles tell us to get out. And here's a great example of why you want to scale out. If we're looking here and being in here until we got a close below the previous low, that wouldn't have happened until this candle. That closed below this previous low. Okay? And then the follow through was at that same level. We would have actually taken a small loss on this if we had followed it along exactly. But based on the size of this move, I mean, we went from 160 up to 260. During that 100-point move, you want to scale out. You want to take some profits here, maybe here, you know, whatever it is. And there's nothing wrong as you're learning this, that when you get to a point, let's say you had about a $90 profit on this and you see this red candle. If you start second guessing yourself, you know, if you're happy with that amount of profit, especially considering that when you lose a trade, it's very small, the loss. You can take it and not feel guilty about it. You can close out your position and just mark it down on your journal that, yes, you broke the rules. You got out early, but you did so because you were happy with the amount of profit you had. Then continue following it along and see exactly where you would have gotten out. Okay? Or if you want, just remove it from your watch list like I do and never look at it again. But if you're learning, if you're still in the learning phase, then follow it along and see whether or not you would have still been right to stay in or not. Okay? But as long as you're happy with the amount of profit you have, take it. Okay? Because you never know when it can turn around on you very quickly. Okay? But those ascending and descending triangles are great. Let's look at the Dow Jones actually today. Let's go to the 1 minute chart, okay, and zoom in here. This is all today. I mean, it's continuing to sell off. But let's look at this area in here, okay? You got a nice downtrend in place, okay? And we can connect these pivot points over and over. You got a nice downtrend in place. What did you get here? Consolidation sideways. What do? Mark these lows and then follow it along, right? All the way through. Descending triangle. Very clear. Okay. All right. I think we got one more here. And then if there's questions, by all means. Bull flag pattern. I've seen this more and more lately because of the big move we've had to the upside. Let's look at something like a Goldman Sachs, which, you know, really carried the market after the election process here and moved higher. Okay, this is sort of like the ascending triangle. Okay, but you get a much sharper move. So when you see a move like this, I want to focus in on this area. You get pretty much a move straight up. Then it goes flat. That's the bull flag talking about. So you're going to move straight up. You want to mark the high of this sideways move and take the breakout. And what you can expect is a move similar in length to the initial breakout. Now, it's always much more positive if you already have an uptrend in place. So here we already had an uptrend. Then for whatever reason, and we know what the reason was here, was the election, November 8th, okay, popped higher. After you see this move and then it just goes silent, you want to mark those highs and see if you can get a breakout. If you do, you measure this move and the breakout is going to be pretty much the same distance. Okay? Textbook. Again, you can let the candles decide when it's time to get out, but at least you know. So if you know you're already 80% of the way into this move, you have a real nice profit. In this case, would have been, you know, from the 210 area, 215 area up to 235 or so, 40. You know, you're $20, $30 profit already in there per share. You can start scaling out. Okay. Let's look at, I think there was one on MAR as well. Yeah, right in here. So, you know, now this one, we weren't really in an uptrend. We got a spike. And this one isn't obviously as clear as the other one. You want it to be more like this, almost vertical. Yeah. Straight up, then you go completely flat. Mark those highs, get that breakout, measure that move, and you pretty much get the same move. Okay? Any questions?
On the channels, Luis was asking, is channel a continuation pattern or a reversal pattern? How do you know which direction it will break while the price is contained in the channel?
You don't. Now, you could use other tools. So, for example, if I put on a moving average on here, like let's say I always like to use the 20 period simple moving average, okay? So let's throw that on here. Move this to 20. And let's make this a little thicker. Okay. So what will happen sometimes through this channel is that suddenly that 20 period moving average will start sloping in one direction rather than being flat. That's a heads up that the move may be coming in that direction. Okay? Something that simple. Now, the longer it goes on, the less likely that will happen. But, you know, you look at these at these patterns, these reversal signals at the edges of the channel, and they tell you that, hey, there's a chance it's going to bounce to the opposite end. Now, look what's happening here. This is when, and we know it broke out this week. Look at the difference between the last few weeks and the rest of the time in this channel. It kept coming back and hitting these lows and hitting these lows. But when it bounced this time and came back, it didn't make it that low, and it turned around. And now that's why that moving average started sloping higher. Okay? So in other words, buyers stepped in earlier, or sellers ran out of shares to sell here. And now we've broken out. And now the buyers are firmly in control, and on they go. So just read it. Within here, you might see a head and shoulders pattern, depending on how wide that channel may be. You may see a double bottom formation. Okay? All of those. So within the channel, depending on how wide it is, there's going to be numerous patterns that might give you a heads up to what's coming. We're all good? No more questions?